Good afternoon, everybody. Live from the office for something different rather than the Shire. It is still a lovely day, but not as good, obviously, outside of God's country. I'm going to manage today with our usual panel of experts, including a special guest staff to give us an idea on what's happening in supply chain in the throes of it. We're also going to look at some of the major issues that are facing the economy going forward. I can't believe that we're in the third round of this. It seems like we've been going for a lot longer than that. Some of the issues are the same, some of the issues are different, but hopefully we're well into a rebound in February once the dregs of Omicron go away. So as you can see, we have our experts there, and we'll work through each of that with Betty, Nicholas and Paul as we get going. I'll get into a summary at the start, but some of the things we're going to get through. Looking at the supply chain challenges, which we're dealing with a lot of clients, and Paul can give us a real in-depth understanding about what's going on, having seen a lot of the overseas markets that we don't necessarily see, but we see the results of it. Interest rate movement, inflation, finance, and all of those things. Betty will give us an update on that so you can understand where the opportunities might be to move. She did tell us before Christmas that if you wanted a rate with a 1 in front of it, you needed to move. So if that hasn't happened, it's the movement's been pretty solid since then. Then we'll look at IPOs and business sales, where they've gone. It's been a record year last year, so Nick will give us an update and a feel about where that's going, and we'll look across some industry stuff there. And then thinking about what the outcome is. Looking at beyond FY22 and into FY23 and how the issues that are coming up are going to impact us. So we'll get moving. So where are we at the moment? Black Friday was massive, across a lot of the retail businesses, excluding food, because obviously they hadn't reopened. Food picked up massively in the start of December before Omicron came through. So this led to a sort of bonanza where everybody was feeling positive, particularly at the back end of November and into early December. This is supported by the ABS stats, which showed that December 2021 was 4.5 to 4.8% above where it was the previous year. It was slightly down on November, so December was slightly down in retail spend on December, but I think that's probably the last 2 weeks of December when Omicron came through and everybody shut down again around that period just after Christmas, which impacted the Boxing Day sales a little bit and whatever else. And that's the shadow lockdowns everybody's been talking about, and that flew into January. Staffing's been a real issue across a lot of retail and a lot of industries, with people deciding to go and look at other jobs or just not being bothered to turn up in key sort of frontline deals. We're also seeing issues coming up at the moment with nurses and things like that, obviously in New South Wales. So that's going to be a key issue and has been a key issue and will be a key issue going forward. There's costs are going up. So how are people managing the costs? Are they passing it on? Because definitely, and we see it in our business and across a number of other of our clients' businesses, that there is major increases or in employee costs, material ones of 5% and above. And that's if you can actually get the staff and the right staff. So that's going to be an ongoing issue, particularly in certain industries where it's difficult. That may change as we get into the next phase where we reopen and the world gets access to Australia and we get access to more people coming into the country, particularly if the university structure reopens. But the overall feeling, I think, is that once these issues or the Omicron sort of issues die down, and although it is very quiet in Sydney today, we're ready for another bounce. The back end of November, I think, shows what is possible if everybody gets into that sort of mentality. And this sort of tracks through in what the NAB latest business conditions talk about. So obviously conditions and business confidence was shattered at the back end of December. Omicron sort of did that, but before that everything was looking relatively positive and everybody was moving forward. With even forward orders, we're a bit more confident. The problem with Omicron is that it did seem to shatter a lot of that confidence, and January has sort of continued with that. Again, I think that is the extended holiday period in January. I think I don't know of anybody who didn't take a reasonable holiday in January this year. Some firms have taken a month off, 3 weeks, whatever else, if they could, or if it didn't damage their businesses too much, to be able to give people a rest and recharge. The big concerning things in there is around forward orders and how that's going to impact going forward. And that may recover in February, so that's something to look out for. And the purchase cost increase, 3.4%, is obviously well above the ABS target for inflation. And what's that going to mean? The ABS is the Reserve Bank, and Dr. Phil, who we'll get to in a minute, has obviously been very consistent about when their expectation is to change rates. But the economy seems to be growing, and prices and wage rates seem to be going up. I don't know what they're looking at in particular, but there seems to be the feel that those inflationary pressures are coming. So overall, hopefully February is a bounce back, but will that drive further inflation and create some more sort of chaos in the economy? Maybe. So what we'd like you guys to do is give us a feel around what's going to happen, or what you think is going to happen in your business around pricing and costs. So are you going to keep them as they are and driving internal costs down? A number of my clients call that just driving the chain down. Or will you monitor it and look at sort of 1 July as a changeover? Or have you just continually passed it on as transport or other prices? And then there's the overall, which is a mix of those things. And obviously competition plays a factor here. Is if you need to remain competitive, that you've just got to absorb these cost changes into your margin, and that impacts your profitability going forward. So these are the types of things that we're seeing with our clients, is around looking at that. And I think that's indicative of some of the things that Nick's going to talk about in the IPO marketplace, where expansion is trying to drive better margins, or at least the volume gives you an ability to pass on economies of scale, so you can protect your margin a little bit. So that's interesting. 54% is a mix. 13% is going to drive it down. 21% will monitor and look at it later. So it's it seems to like everybody is applying their own little different approach, which is logical in this sort of differential market. Other external factors. Ukraine and Russia is really impacting oil and petrol prices, although there is some sort of profit taking, obviously, in petrol at some stage. It just has to be there. You can't justify potentially getting to $2 a litre for petrol in Sydney without trying to recover some of the losses that they've made, because people haven't been using petrol for as much for the last 2 years. I can still remember paying $5 for half a tank of petrol, but that shows you how old I am. So that'll be an issue going forward, I think, and depending on what happens with Russia, it's obviously impacting the US markets, and it's impacting then the global financial markets. That's just something we've got to work through. Inflation, as we talked about, interest rate increases around the middle of the year are possible. Everybody's listening to Dr. Phil Lowe from the Reserve Bank, everything he says, and it's slightly different, it seems, on different marketplaces. And he acknowledges that they're monitoring things very closely, and things are moving around. Wage rates are definitely moving around. And also there's inflationary pressure from all of the supply chain costs going up. So what does that mean on property markets? It may well be, and we'll ask Betty about this as well, rates could impact continual growth. It also could be very different in the higher end property markets and the lower end property markets as affordability becomes more of an issue. And then that'll also have a flow-on effect to SME funding as rates start to push up costs into the 6s and 7s rather than at the 4s if you're a very good business now, and that will impact decision-making going forward. Talking to clients, and we'll get to this with Paul as well, double the time of supply to get things supplied in certain markets and for certain suppliers. That's just a reality, and there's a little bit of a guessing game about when things will turn up, whether they get onto a boat, whether they get through customs, when they get out of a port, and extra costs. That impacts the ability to be able to manage a business. So it is a little bit more of a hot shoe shuffle at the moment rather than a managed process. That is an issue that just needs to be dealt with as you go forward. However, it obviously creates more chaos because you can't provide any certainty around delivery and your cost structure. So that's going to impact a lot of those. The border openings, hopefully we get those done shortly. There will be some belly plane capacity that Paul will talk to as well, around, which should help with some of this supply. And we also should get the university-related industries up and running, hopefully, in the next 6 months, which has a number of flow-through effects, particularly in retail and capacity to be able to find employees of interim sort of work labour, whatever else. So there's a lot of things that'll move around, and most of them are positive, and hopefully they support this sort of bounce back that we saw in November that can happen again in the rest of the month and then into March. That's the summary. It's a strong rebound. Hopefully it's back, the bounce, and we get into a really strong position. That should drive and give confidence to everybody to get back into the economy. Omicron, hopefully it dies out a little bit. It took a lot of oxygen out of the economy and the rebound. We were really tracking positively before that. So over the next few months, we're hopeful of getting back to that, subject to the potential headwinds that we have talking about below. I've already talked about staff availability and supply chain. They're things that are just going to be there, I think, over the rest of the year. That's going to impact your cost structure, how you deal with that in your margins. As we saw, everybody's got their own take on it and their own view. And then we have the ace in the hole, which is the election, the federal election, which comes up in the next 3 months. What impact's that going to have on the economy, on inflation, whatever else? Are we just going to sit? Is the economy just going to sit and wait and see what happens? I think everybody can see that we're a little bit unclear around what policies are clear from either side and what's going to be implemented. So that's also going to have an impact, and we are really guessing about how that will play through. So that's where we are at the moment. We've got potential real big positive coming in the next 6 weeks, hopefully, but there are some headwinds out there that need to be massaged and managed. So we'll move on to the experts and get their views around some of those issues. Do you want to have a quick chat around how rates have moved since our last chat in December and this comparison that you've put together?
Sure. Thanks, Todd. Thanks. Good to talk. So, yes, since we last spoke in December, and as we suspected, fixed rates have certainly been creeping up despite the cash rate remaining stable. So in December last year, the sharpest fixed rate was at 1.89, and today it's at around 2.54, which is a 65 basis point increase in 3 months. $6,500 on a typical $1 million mortgage, $125 a week if you've got a $1 million mortgage. So if predictions are correct and the cash rate increases to 1.25 by the end of next year, then you would expect interest rates to be in the high 3s by next year and probably in the low 4s by 2024. And this is obviously reflective in the pricing with the fixed rate, because the variable rate, they've actually remained pretty much the same despite the sharpest rate at the moment at 1.89%, but that's at an LVR of 50%, and the smaller players as well, not necessarily the majors. What else can I tell you? But will borrowers be ready with these rate rises? I mean, I'm on the front line, I'm lending money all the time, so I do believe they will be ready, because when it comes to assessing applicants' capacity to borrow, we use an assessment rate which is 3% above the actual rate. So we do apply a buffer, or the banks or the lenders do apply buffers. And so you're actually assessed at a rate of around 5.25%, and that varies. Some lenders are still using 7%. So, and I say this to my borrowers as well. So depending on which bank you go with, every bank has a slight tweak in how they assess your capacity to borrow. So borrowers will be ready, I believe. So the future is looking very interesting. If you were one of the lucky ones back in late 2020 to fix your loan at 1.89% for 4 years, it's a pretty amazing rate. So, because all predictions are headed for an increase for sure.
And Betty, the Reserve Bank's sort of been saying they'd like to get base rate cash rate back to 2.5 over the next 2 to 3 years, so that they
That's
can
right.
actually utilise interest rates to have an impact and an influence.
Yep.
So that would probably get it to what, 5% in terms of a variable rate?
That's exactly right. So I've been lending money for over 20 years, and back in, 10 years ago, an interest rate of 7% was considered normal, quite honestly. Like if you had an interest rate of 6.5%, 7%, that was a normal interest rate. And for 10 years, we've had consistently low rates, right? And we had low threes, we thought was fantastic. The high, the twos was meant to be amazing. And then we even saw the ones. And I do, we can all sort of probably agree that we are at the lowest rate, that the cash rates certainly hit the lowest, and that we're on the way up, and that rates will probably stabilise at 5%, which will, impact property prices, no doubt. We're about to open our borders, so I don't know what that means for property and for, international buyers, etc. But I'm sure I know with my borrowers that there's an element of caution, and that the first question that they want to, know is, what's the fixed rate? What does that mean for my debt? Even though, they're in a strong position to service the borrowing, there is an element of caution that I'm consistently seeing across all of my clients, for sure.
Well, if you look at it going from 1 and a bit or 2 to 5, is 2.5 times in interest that you're actually paying, depending on what your base is, right? So that is going to drag money out of the economy somehow.
Absolutely. And and today rates are so low, people are taking advantage of it. Are people planning on the rate, a rate rise and saying, well, in that position, in 5 years' time, I'll just have to curb my spending? Because, when it comes to borrowing capacity, it's not just the assessment rate. We look at, declaration of living expenses as well. And the categories there include entertainment expenses, which holidays, pet care, not that you're going to give up on your pet care, but it's just an example of how much detail goes into
there might be less racehorses being acquired at that stage, Beth.
That's true. So, so living expenses is definitely a massive factor when it comes to assessing a borrower's capacity to borrow. And and the banks will, when it comes to living expenses and entertainment, a lot of my clients are saying to me, look, I probably live a bit beyond my means at the moment because I can, but, moving forward now I'm going to have, exactly, I will change, and I plan on changing because now I'm going to have this debt, right? So, and that makes sense. So you'd expect that same analogy will be applied if the 5% interest rate, eventuates, which it probably will in 2024, 2025, potentially, that you will have
particularly if the economy's growing. Like the economy's growing then on that basis as well.
Well, that's right, and the economy's growing. That's so it's a great thing. But at the same time, you'd probably have, people will readjust, and the banks are very focused on reputation, as we all know. So I do believe that even in that small chance, or in the chance that, also I don't know if it's small, but in the chance that a borrower does get into some difficulty, that if the rates do rise, and I think the banks are there to help customers now. I don't think any bank wants to go out there and just, step in and take over the property and sell. And so I do believe that it's a very different world that we're living in. Reputation, bank reputation, is a huge part across all the lenders. Everyone's around reputation risk. So, and hence the amount of offerings, exactly. So, and all the credit parameters, they're just so much harder as well, right? So,
but Betty, against that, you look at some of the big four have all done their announcements over the last few weeks.
Yeah.
And there does seem to be more competition coming through as well. You're either a winner or a loser if you're a large bank, if your mortgage business is going well or not as well. because
That's right.
it's a key to your growth. And Macquarie obviously are shooting the lights out as well with that part of their business.
They are, and
So,
I think the word was that they've not. Well, I do know that they've knocked off Westpac, right? So they're now considered a big four. So because they have grown so much, and I mean, I'm on the front line again, Todd. So I'm only speaking when it comes to my world and my opinion. But you know, a bank like Macquarie has every reason to be growing because they've really looked at product, they've looked at pricing, they've looked at process, they've looked at system. They've got incredibly dynamic systems behind them to support them. They've got reputation, they've got brand.
yeah, they're sort of big enough to be able to play, and that gives them a bit more credibility than some of their other smaller competitors, I would have thought.
Well, that's right, and you know, to have taken, it's almost, they've almost still got a bit of a prestige brand as well behind them. So if you've got your home loan with Macquarie, it's actually, there's a bit of a it's a great brand, and for every reason, right? So, but yeah, you're right. There's a shift in the market on so many levels. I mean, there's new players, as we spoke about last time, like Athena Home Loans, that are really, you know, shaking the market and really making, again, lenders look at their product offering. And, you know, in the past, there was no pricing around loan to value ratios. It was, you know, the first change was the pricing around owner occupied to investor, then interest only. There were pricing differentials. And now it's quite normal that all lenders offer differential pricing on loan to value ratios as well, because of players like Athena that have come in and said, you know, we're going to reprice your loan as your mortgage drops or as your loan to value ratio drops.
And how's that going to be impacted if house prices change, maybe go down?
Well, good question, right? So, I mean, at the moment, the way that would work is that the loan to value ratio would be assessed on the value of the property on day one. So assuming in 5 years' time the property price has gone up, or we just assume the property price has gone up, and also the principal loan amount has reduced, and therefore the loan to value ratio has reduced. So if you look at their product, they've actually got an estimate of when the loan to value ratio will drop and when the interest rate will drop. I mean, there's no guarantee around it. So the only way that a lender like Athena can guarantee that in the future if property prices drop is to actually physically go out and get a valuation on that property. And that's not something that you would ordinarily do for an existing customer, because it's a set and forget loans essentially for 30 years, unless you have borrowers that are proactively looking at their debt. And as they should be looking at their debt, I say to my clients all the time, if you have been with your bank, regardless of what bank it is, for 3 or 4 years, it's a long time. Make sure you look at your product, your interest rate, compare the market, right? Because it's forever a changing feast. The strong players today don't necessarily mean they'll be the strong players tomorrow. It's always changing.
So I think that's a good moral to go away with is to be, because competition's going to change, and you can see how ANZ have fallen a bit away behind. So they will obviously then reinvigorate their offering and have to come back.
They already are. Yeah, exactly. I mean, I've just got an email from ANZ saying exactly what you've just said, because they are going, their ANZ's focus would be, let's focus and our niche be on our professional market, right? So they've got this fantastic offering now for medical professionals where they'll do 95% LVRs with no lender's mortgage insurance. And also they've opened up this 90% no lender's mortgage insurance to the rest of the medical market, like veterinarians, optometrists, lawyers, accountants.
Are we medical as well, are we?
Well, no, but you're professional. You are professional. Well, not necessarily. Yeah, no,
some
you
of
are
us
professional. So that's ANZ's niche, right? And that's something that they do incredibly well, and that's their target market, and they do it really well. So and they're really pushing that now.
So your message is almost every couple of years when you're doing your tax returns and you've got all your information together is maybe go, okay, let's just ask the broker, what are my options? Can I get a better deal? Because it doesn't cost you anything, right? It's just a transition. It just costs you the time to actually go through that process.
No, that's exactly right, Todd. It doesn't cost anything to use a broker. It's the bank pays the broker for the time that they've spent processing the application, like a full-time employee, right? So yeah, it's exactly right. So the tools that I have available are, you know, a system that actually does a really detailed search on your particular product, your particular need when it comes to investment, owner occupation, LVR, and it will determine an interest rate. A lot of the majors are actually also open to price negotiation as well. So we've got access.
Existing. So you don't ask what you don't get.
That's right. So you've got to ask. That's exactly right. And also, I mean, a good broker will continually monitor that rate and continually reprice it, and will assist you get it repriced with your existing lender, or, you know, show you what you could potentially do with a new lender.
All right. Well, that's been helpful, Betty. And I think it's a good transition talking about rates going up and people using the low rates to buy things and businesses and whatever else. So I'll transition across to Nick to talk about the IPO last year, which was pretty outstanding.
Thanks, Todd.
Thanks, Betty.
Thanks, Todd, and good afternoon, everybody. Todd, you are correct. Last year was a record year for new entrants to the ASX. So HLB mandated to conduct an annual report of new IPOs to the ASX market called our IPO Watch, which was released last month. And quite astounding, really, 191 new entrants to the ASX last year compared to about 70 odd in the prior year, which not surprising that 2020 was compressed with the obviously COVID pandemic. What you see on this slide here is obviously there was a real ramp up in December 2020 at the sort of, you know, towards what we thought was the end of the pandemic in Australia at that time. But you see that even rolling into 2021, when we arguably were facing the sort of the height of the pandemic in Australia, the new market entrants just continued to be strong. So quarter on quarter, building obviously to the December 2021 quarter, which was a record. Very interesting in that the quantum of cash raised, but also just the sheer number of entrants to the market.
And Nick, they're not all just tech. They're not all just tech, are they?
Well, really surprisingly, it's our largely WA and Queensland-led materials businesses. So, not surprisingly, Australia has and the ASX is a really supportive market for new entrants in our resourcing and mining sectors. 107 of the 191 entrants to the markets were materials related. So that is somewhat not somewhat surprising that that's the leader, but I think the sheer quantum is always surprising. So there's a lot of new projects going on in the resource space, probably driven by, you know, interest in commodity prices and obviously in some of the new or newer metals prices, which are going into our changing global use and demand for mineral sands and the like, to be used in batteries and computer chips and other uses. On the technology space, so the technology gets a whole lot of headlines. There's been a number of successful Australian businesses in the technology space, but there was only 9 listings on the ASX in 21, which is a similar number to 2020. And of course, pharmaceuticals and life science is also well represented during the year. So a good mix. I think there was over 21 sectors represented across those 191 listings. Message being that good businesses have been well received by the ASX. There's a lot of speculative cash around, which was happy to be deployed into these businesses. Probably a reflection of lower returns on cash in other areas. So the ASX and capital markets in general have had a pretty strong year up into Christmas. Obviously, a bit of volatility since then. And, sort of, I guess, a little bit of uncertainty about what's going to go on forward, particularly with some, global geopolitical activity and the like. But yeah, look, I think the outlook is, and we're hearing there is still quite a lot of interest and some good businesses that will again come to market during 2022. If this is something which is obviously of interest to most investors into IPOs, and that's the performance of the share price post-IPO. By very nature, investing in the market is going to be speculative in nature. Most investors would hope their share prices will go up. And it was positive that as the time of running this, which I think was at 31 December, very close to the peak in the market, the majority of IPOs had performed well post their listing. So that is obviously a measure of share price at the date of listing through to 31 December 2021. So look, it is up and down by sector, but in general, it just picks over to be a positive. So that's obviously an encouraging sign for the any IPO aspirants. It helps with the fundraising. Helps with the brokers, obviously, selling the proponents to the market. And, it's good for the investors to be getting an opportunity to be exposed to and support some of these new and emerging businesses.
And Nick,
obviously, within...
Nick, sorry, quick one. A lot of that energy stuff, I assume, is in the specialised sort of space transitioning across.
Yeah, correct. So we're seeing there's sort of two movements in the energy market. There's some, I guess, some older, more traditional assets that might be being spun out so that some of our more diversified energy companies will split their assets between potentially their older style baseload assets with their renewables and new energy. And then we're also seeing both in the public markets, but also in the private space, continued investment and interest in newer renewables energies, and a whole load coming through there in a range of technologies, from energy generation through to storage. And that's I think, a thematic across the economy in general, and we foresee there to be continued interest and activity in that space, and that's not just an Australian piece. That's a global interest there. One of, I guess, just before I move on, obviously that's a good snapshot on the ASX markets, but there's still a lot of investment that happens outside of the public markets. We're seeing huge inflows of cash into the venture capital space in particular. So they are supporting earlier stage in innovative businesses. I think the Australian Investment Council in their report for 2021 indicated that there was about $1.8 billion sitting in reserves in venture capital funds to be deployed in early stage businesses. And that's before you account for some active fundraising that's going on at the moment. So you'll see some of our well-placed Australian venture capital funds are looking to close $500 million plus funds. So would anticipate there's going to be continued real strong focus on the venture capital space. And Todd, I think that's where you see some of the headlines, based on some of the successful Australian businesses that have been growing out in the technology space and really achieving great things on a global scale. The Australian venture capital market is maturing. It's getting great support from the wider investment community. We're seeing the the superannuation and the pension funds contributing to that space as part of their diversified investment portfolios. Likewise, there's getting great support from some government incentives and initiatives to really try and innovate and grow our economy, and that's across many sectors. So it is a positive one to see.
Yeah, I think from talking to the funds that we've been speaking to, they're very keen on innovative businesses that are changing the way things are being done and are motivated that way. And they can see the global implications of being able to prove that, particularly things on around food and transportation and things like that, which are reproducible. There's also unique opportunities for things like wine to be able to get back into that, while there's a sort of supply issue with the Chinese sort of supply being turned off. And the underlying thing I think that they see is there is always good businesses. It's about finding those good businesses and providing them with the capital to be able to grow at the right time and provide them with the right support. And we seem to be a little bit better at doing that now than we have been previously in this country. And then we open up these things across the world, and there's great ability to be able to expand.
Oh, absolutely. And I think when you look at some of the great Australian businesses which have continued to operate in the private sector for long periods of time, often generational. You look at any of the corporate statistics, by far the largest contributor to the overall space is small privately held businesses. They're fundamental from both an employment perspective, but also contributors to the economy, and often operating below the radar. But there is a lot of fantastic SME businesses out there, and there's again growing maturity in how those businesses can get support for growth, whether that be debt or equity capital, and also at the end of their founders run with those businesses when they're looking for exit opportunities, whether that's for retirement or just succession and moving on to do other things. Again, sort of growing sophistication around how those founders and owners and operators of those businesses can be helped through that transition, and whether that can be into private hands or acquired by a larger trade acquirer. There is great opportunities out there.
Yeah, and that seems to be an issue now where people have come through COVID and have decided that life's too short and I'm ready to move on, and they're looking at that opportunity as well.
Yeah, so we're obviously seeing that, and you hear a lot about that from the employee market and the challenges of potentially retaining staff and or incentive for staff to move on to new opportunities. It's not dissimilar to what we're hearing from SME owner-operated businesses, where they may be taking the opportunity to reassess what their aspirations are for their sort of near-term or longer distance future, and potentially selling or stepping back from their business might be one of those factors that they can consider. And for a lot of people, that's a release, or could be a release of a significant piece of wealth, often the largest asset they have outside of their personal residence. And so you want to make sure they can maximise that wealth, and then obviously in a tax-effective manner, repatriate any proceeds that come from that sale. So
there's a reason why golf memberships have gone up over the last couple of years.
Well, and there's a bit of a resurgence there, right? So the golf sector was struggling there for a bit, but and look, I think that's hopefully a reward for some of these business operators, because we do know that operating and owning a small medium-sized business can be a all-consuming task at times. So we like to support those founders and operators of those business on successful exits when the time is right. And like everything, it's about being prepared. If they can have some time frame to get involved engage with some experts and get prepared for an exit. hopefully see a much more successful outcome and something that aligns and meets with their expectations.
So Nick, I think you're going to, and Nick and I are going to have a chat with Paul about, as our special guest star, around some of the things that are actually driving the realities in this marketplace and the economy. I mean, I'm hearing stories with fashion retailers where it is taking double the time to be able to get things into the country from their Chinese manufacturing, and how that all plays out now with this marketplace and costs going through the roof. So, I mean, Paul, what are your members and you seeing across all of these things, and how is this going to play out over the next few months?
Good afternoon, everyone. Well, being in this industry for nearly 41 years now, and I'm showing my age, Todd, I've never seen it in the last, say, 2 to 3 years as confused as it's ever been. Where we've all heard about the just-in-time inventory theory, now I'm hearing it's just in case, where they've got to keep the stock levels, higher than they once did. I mean, this is just it's a total change in the logistics landscape, not only in Australia but the world. You've got our biggest trading partner being China, and over the last 20 odd years, most of when I was working in the industry, 60% of our revenue came from China in some cases, depending on where you were. But now, because China's had this bit of a meltdown, course of COVID, people are starting to look at, where do I source my goods? Do I have to be so entrenched with China? Can I source it from somewhere in Southeast Asia, like maybe possibly India? And there's the Philippines that have got great manufacturing. I've worked up in the Philippines for 4 years, and they've got a lot of great manufacturing abilities up there, good English, and also Vietnam. We are doing a bit of work with the Australian government and the Vietnamese government on teaching logistics up there, because we've got 2 diplomas. So it's changing everywhere. Like if you take the sea freight component of the logistics, in the past 5 years, a lot of the shipping lines are merging by acquisition. So some of the big ones are getting bigger, and the nimble, smaller ones who were prepared to negotiate are no longer there, or very few nowadays. I mean, in years gone by, and the shipping lines never made a great deal of money. If anything, they were losing. Now it's multi-billion-dollar profits. Some of them are just releasing their 21 figures, and they've never made this much money in their whole entire, time they've been around. So it's one of those supply and demand. There was a container shortage, which is now starting to be alleviated in China, and they're building them. And
did we send some back, Paul? Because we've got plenty out here.
Oh, well, that's a good point, Todd, because middle of last year, we had container yards stacked 6 high, and I went down there to have a look, and it was very, very dangerous in actual fact. 6 high, because I had nowhere to put the empty containers, because the shipping lines were just bringing in import containers and not taking out enough empties. That has sort of calmed down a lot in the last 6 months. So there's not that space problem.
And it wasn't just here; it was in America as well. America had the same issue.
Yeah, they had that issue, but in China, in India, in those areas, large manufacturing areas, they didn't have any empty containers. That was all down in everywhere else. So they had to reposition them eventually. So that was a bit of a problem. So with the shipping lines, they've increased their price, and sometimes 400%. I mean, it's amazing what they're charging, and they can do it because of the supply and demand.
And then there's port fees and extra port fees and all those handling fees.
Yeah, the stevedores have been, we've spoken to the IFCBAA about this, and they've got a bit of a watchdog on what's going on down there now, and they've increased dramatically. They're putting on charges for, every 6 months there's an increase. And that has to be passed on to somebody. And I don't believe the importers or the exporters can continue to absorb those costs. So at the end of the day, the consumer will have to pay.
Or it'll get pushed down the chain into some other supply sort of mechanism, because the guys I'm talking to in fashion retailing, for instance, they're talking about how they have to have somebody sitting in a truck for 3 days out the front of the manufacturing site to wait for the product to be produced, to get it onto the truck as immediately as they can, to get it to the port, to hope and pray that they can get into a boat as soon as they can. Because you're right, all of the restrictions that are in China, not just in the port. So there's reduced headcount operations everywhere, through retail, through manufacturing, all the way through. And that's slowing everything down and adding costs to everything. And then it can sit in the port, if you're unlucky, for weeks.
Yeah. I mean, I've got I have a member who's got 24 containers in Savannah, and they've been there for 6 weeks. They can't move them. So, I mean, then what you've got here, like you've got that, because it's just everyone's coming down with COVID, and you've seen it in Australia with the warehouses, and take the food supply for one. I mean, you go into the local Coles or Woolworths, and sometimes there's not enough product there. I mean, that's just the reality of it. I believe it's starting to sort of get that over that bad hump that we had in January, where people are getting tested on a regular basis, and that it's all coming back. So, but you know, we've got that on the sea freight side, and I believe the prices on the sea freight rates will not change. I don't think they're going to be going up on a steep incline. I think they may be plateaued on the rates they've got now, but I don't think you'll be seeing any sort of reduction of costs or prices probably until mid-23.
Well, if oil price is going up, bunker will be going up as well. So it'll cost more to actually get the ship here as well. So everything's just going to be perfect storm. Well,
or just on the bunker, that's the fuel that the shipping, the vessels use. That's their term. Was $200 a ton in 2020, late 2020, $200 a ton. Now it's $700 a ton. So that's one of the cost increases that they're,
so be thankful that Sydney petrol prices haven't gone up at the same rate as what bunker has.
Yeah, exactly. So that's one of the things that's happened in that. And now you take the air freight, because there was no one traveling in 2020 and most of 21, the planes had to be parked. So a lot of them still are parked because, capacity, people aren't willing to travel as much because they're still a little bit wary. And this is where, passenger, out of all the aircraft in the world, 20% are only freighter aircraft. That's cargo only. The other 80% are passenger aircraft, and they take probably a majority of all air cargo. I mean, no one really realizes when they're on a, take a 747 for in fact, you're sitting on all this cargo underneath. It's not only just bags, it's all sorts of stuff. So, the shipping lines have taken a lot of that on as well. So that's part of the problem issue. And then e-commerce has just gone through the roof. I mean, they call it the Chardonnay shoppers on a Friday and Saturday night. They have a glass of wine and start getting onto the internet and buy eBay or whatever, Amazon, and go crazy. So
that explains why things turn up on Tuesday and Wednesday at my house then.
Yeah, probably so. So and it's just the way. And then so that the likes of those big companies like Federal Express, UPS, and all those guys, they are flat out. They're having problems with staff shortages as well. I mean, to the maximum. So, but once travel is starting to pick up, you'll see maybe a little bit of a decline on the sea freight, and that's going to be a bit of competition for them. So, and that's, I went to Europe just before Christmas, and the plane out of Sydney to Dubai wasn't very full, and then from Dubai to Munich it wasn't very full, but coming back it was chock-a-block into Sydney. So it's starting to happen again, and people are starting to get a bit more, I suppose, confident about traveling. But the thing is, the domestic travel in Australia, I mean, that's, you know, it was easier to go to Germany than it was to probably go to Queensland.
And all that means is that we're just going to have to grin and bear it probably for this year and maybe next year. I understand there's some new boats coming online next year, which will probably alleviate a bit of this.
Yeah.
Obviously, the planes will do that as well. So it's just a sort of hold firm for the year.
Yeah, I thought about the vessels. Yes, there's about 12 or 13 coming into service at the end of this year, but a majority of the other orders will not be commissioned until mid-23 to late 23, and that's why I'm saying the freight rates probably won't be coming down anything until mid-23, because once those vessels are online, it'll be the old supply and demand theory again.
Well, at least there is some light at the end of the next sort of year. It's not just going to be a continual spiral, but we just got to hold firm, and hopefully Australia can find some more things to put in some containers to send overseas rather than resources and whatever else.
But in saying that, Todd, a lot of only a very few of my members said they've had not a really good year in 21.
Yeah.
So both 2020 and 21. Most of the members were having good years. I mean, they're pulling their hair out because of all things that are going on. It's never been like this before, but they are having a pretty good year.
Well, you'd hope at least somebody is making some money through this process.
Yeah, well, it's not that they're making, because the costs have gone through the roof, so their revenue was high.
Yep.
But their profitability has not changed a great deal.
It's just become a massive volume increase.
Yeah, and price increase, and hence a lot of them weren't able to get the government incentives because of the revenue. But it doesn't mean the bottom line's any better.
Yeah.
And we're seeing that flow through to some of the investment in, commercial real estate and logistics infrastructure. So that particularly, as Paul mentioned, on the supporting the e-commerce and the distribution, that we're seeing quite significant investment into those fulfillment facilities, and the expedience that some of these parcels can from order through to dispatch to receipt by a customer. There's a whole lot of investment in that technology and distribution networks, which supports that whole e-commerce, which we could anticipate is going to be around for many years.
Yeah, well, actually, that's a good point, Nicholas, because space is at a premium. I mean, in Asia Pacific, we're the largest warehouse and storage region in the world, with about 33% of the total space in warehouses, and that's why a lot of the companies are going out west in Sydney for the land, because as I said before, it's just in case. Will this continue? I'm not sure. Once we get past this COVID thing and all the stoppages that we've had. But warehouse space, and that is very tight at the moment.
The moral of the story I think we've gotten to is still consistent with what we've sort of been saying throughout this process. Watch the economic data, including Dr. Phil whenever he's on, and try and understand where the Reserve Bank's going, because that's going to be important in terms of rates and inflation and how that's going to impact everything going forward. Thinking about that in your strategic plan. Looking at your facilities, I'd be looking at them now and seeing whether there is any opportunity to be able to minimise the impact of what's probably going to come, and making sure you got the right mix to be able to maximise that. Share information and talk to everybody in your network, and really work that over so you have an understanding and seeing what's across all of the marketplace, so that you can see that before it impacts you, and have a plan and understand what your strategy is so that it can be adjusted. Like we've talked about costs and how you're going to ride that, and working that through your business model to protect your business and your margins, and ultimately your profitability and your investment. Because if you don't protect that, it can quite easily turn on you very quickly. So it's important to understand all those factors. Yeah, politics are going to be a problem. So I've heard of American brands being told or directed to not continue to utilize China as a supply channel, and they're looking at alternatives. So that could have a play out over the next few months as well. And as Paul said, they're looking at alternatives across Asia and Bangladesh and as options. But I think Vietnam is exposed at the moment. There seems to be a lot of hiking boots that are made in Vietnam, and they just don't seem to be able to get enough out at the moment. So each of those little markets have implications across the world.